So there's a lot of vacant office right now in the Chicago market. And if you look at the data, it's gotten worse. Right now, we're seeing 28% vacancy, and the net absorption rate shows that in the loop alone, over 50,000 feet just came on the market. What the heck does this mean? Well, for office landlords, this is not particularly good news. And it's even worse news for the city that relies on taxation, office buildings to fund all of their financially distressed pensions and all the financially distressed liabilities that the city has. So generally, this should be troubling to all Chicagoans. A long-term vacancy rate of 28% is structurally disruptive, and it could result in defaults across the board, making the situation even worse. The narrative that downtown office space would recover post-pandemic is increasingly coming into question, leading a lot of analysts to believe that things are likely going to get worse. The only likely good news is for office tenants, space is likely to get less expensive, which means that you'll see more incentives and tenant improvement dollars, and it'll generally be easier for businesses to find space in Chicago. The bad news is for everyone else, distressed office could spark huge budgetary issues on the city level and just huge financial issues in commercial real estate markets. So if you're an investor or you're looking at becoming an investor and you see a vacant office tower, the future probably isn't bright. The only potential bright spot for investors is there might be opportunities to buy in other than for land sales. However, they will have to buy in at an incredibly low entry point to make deals pencil.